3 months ago, Patricia walked into a mortgage office with a 621 credit score. The loan officer told her she'd qualify, but her rate would be brutal. 7% on a $350,000 home. That's $180,000 more in interest than someone with excellent credit for the same house, same income, same person. Patricia asked for 90 days. The officer smiled and said sure, but warned her not to expect miracles. Credit scores move slowly, he said. A few months wouldn't change much. 93 days later, Patricia returned. Her score was 761. The loan officer asked if she'd submitted the wrong Social Security number. She hadn't. That 140-point jump saved Patricia $247,000 in lifetime interest. Not a typo, $247,000. What Patricia discovered wasn't a hack, wasn't a scheme, wasn't disputing accurate information or exploiting glitches. It was a legitimate feature of how credit scores work, hiding in plain sight. The financial industry profits from keeping it obscure. Today, I'm showing you exactly what Patricia learned. By the end of this video, you'll understand why everything you've been told about building credit slowly and responsibly is technically true, but practically designed to keep you paying higher rates for years longer than necessary. I'm Anika. I spent 8 years in credit risk analytics, watching banks optimize for profit, not for you. Subscribe if you're tired of being the product. Let me start with the lie you've been told. Pay your bills on time, keep balances low, don't open too many accounts, and wait. Wait years, wait decades. Let your credit history age like fine wine. This advice isn't wrong, it's incomplete in a way that benefits lenders enormously. Every month you spend in fair or good credit instead of excellent credit costs you money. Higher credit card rates, worse auto loan terms, steeper mortgage rates, higher insurance premiums, larger apartment deposits. I call this the credit score tax, and it falls heaviest on people who can least afford it. The slow, conventional path keeps you paying that tax for years longer than necessary. Banks profit from this timeline. Someone with a 680 score who could have a 780 score is a more profitable customer. They pay higher rates, generate more interest revenue. The bank has zero incentive to help you escape quickly. But there's a faster path the system allows. Nobody advertises it. I'm going to show you 5 mechanisms that can jump your score 50 to 150 points in 60 to 90 days. Legitimate, legal, hiding in plain sight. Patricia's breakthrough was something called authorized user trade lines. To understand it, you need to know how credit scores actually work. Your score is a statistical prediction. How likely are you to default in the next 24 months? The algorithm compares your patterns to millions of other consumers. 5 factors matter. Payment history, 35% of your score. Credit utilization, 30%. Length of credit history, 15%. Credit mix, 10%. New credit, 10%. Here's what nobody explains clearly. Factor 3, length of history, isn't just a function of time. Most people think, I opened my first card at 18, I'm 30, I have 12 years of history, nothing to be done, just wait. Wrong. When you become an authorized user on someone else's credit card, that account's entire history appears on your credit report. The account's age, payment history, credit limit, utilization, all imported as if you'd been part of that account from the beginning. Read that again. If your mother has a 23-year-old credit card with perfect payment history and low utilization, and she adds you as an authorized user today, that 23-year-old account appears on your credit report immediately. Your average account age could jump from 2 years to 12 years overnight. Your total available credit could double or triple. Your longest account history could extend by decades. This is exactly what Patricia did. Her mother had 3 cards with combined age over 40 years, perfect payment history, utilization under 5%. Patricia became an authorized user on all 3. Within 2 billing cycles, those accounts appeared on her reports. Her thin credit file looked robust. Her short history looked established. 140 points. This isn't a secret to industry insiders. Mortgage brokers know, credit repair companies know, banks definitely know. It's rarely advertised because there's no profit in shortening your time in high-interest purgatory. Let me show you this works across different situations. Marcus, 24 years old, credit score 589, made mistakes in college, missed payments, maxed out a store card, trying to finance a used car. Every dealer quoted him 14% interest. His grandfather had credit cards dating to 1987, spotless history, combined limits over $60,000, utilization under 3%. Grandfather added Marcus as an authorized user on his 2 oldest cards, never gave Marcus a physical card, never gave him access. The addition was purely strategic. Within 60 billing cycles, those accounts appeared on Marcus's reports. His thin credit file looked robust. His short history looked established. 589 to 697. Crossed the threshold for reasonable auto financing at 6% instead of 14%. On a $25,000 loan over 5 years, $5,200 saved in interest. Grandfather's action, 10 minutes online, transferred decades of creditworthiness instantly. Now let me walk you through 4 more mechanisms. Mechanism 2, the utilization timing hack. The 5 mechanisms and action plan. Your utilization ratio, 30% of your score, is calculated from balances reported to credit bureaus, typically on your statement closing date, not your payment due date. You might pay in full every month, never pay interest, use cards responsibly. But if you're charging $2,000 on a $3,000 limit and that balance appears on your statement, you're showing 67% utilization. Your score is penalized even though you pay in full. The hack? Pay down balances before the statement closing date, not just before the due date. Reduce to $50 before statement closes. Show under 2% utilization. Score jump? 20 to 40 points in 1 billing cycle. Mechanism 3. Credit limit increases. Utilization is a ratio. Improve it by increasing the denominator, your credit limits. Many issuers offer limit increases with no hard inquiry. American Express, Chase, Bank of America, Capital One, Discover. Request through app or website, often approved instantly using soft pull, doesn't affect your score. Double your limit, halve your utilization ratio. No change in behavior, immediate score improvement. Request increases every 6 to 12 months. Someone starting with 10,000 total limits can accumulate 50,000 plus simply by asking. Banks don't advertise this. Higher limits mean you could carry higher balances, but also means lower utilization and better scores. They prefer keeping you at limits that maintain profitability. Mechanism 4. Strategic account closure. Conventional wisdom: never close old accounts. Misleading. What matters, age of oldest account and average account age. Closing a new account might help your average age. Closing your oldest account definitely hurts. Strategy: review which accounts drag down your average age without benefit. That store card from 2 years ago? Close it. Your oldest credit card from 10 years ago? Keep it open indefinitely, even unused. Mechanism 5. Rapid rescoring. Most consumers don't know this exists. During a mortgage application, time matters. Normal credit updates take 1 to 2 billing cycles. Rapid rescoring updates specific items within 72 hours based on documentation you provide. Pay off a $5,000 balance, provide proof, updated zero balance appears in days. Only available through lenders during active mortgage applications. Strategic timing, make major improvements during your mortgage process, not months before. Combine strategies with rapid rescoring, 50 to 80 point jumps during application itself. Let me give you your action plan by current credit score. If your score is below 650, authorized user strategy offers largest impact. Identify family members with old accounts, excellent payment history, high limits. Request authorized user status on 1 to 3 accounts. Simultaneously, address negative items through proper dispute channels. Pay down balances below 10% before next statement closes. If your score is 650 to 720, optimization zone. Multiple small improvements create significant gains. Request credit limit increases on all existing cards. Adjust payment timing to reduce reported utilization. Consider authorized user strategy if thin file or short history. Check for old negative items qualifying for goodwill removal. If your score is above 720, likely fine for most purposes, but optimization still matters for best mortgage rates. 750 versus 780 equals meaningfully different interest rate offers. Focus on utilization timing, limit increases, maintaining positive patterns. Everyone, pull 3 credit reports from all 3 bureaus annually, review for errors. Studies show meaningful percentage contain errors affecting scores. There's a deeper truth underneath these tactics. The credit scoring system was designed by lenders to predict risk for lenders, not to help you optimize your financial life, not to help you escape high-interest products faster, to help banks decide how much to charge you. The system reveals certain information, obscures other information in ways that serve institutional interests over consumer interests. Banks don't explain authorized users because it helps you escape their high-rate products. Credit bureaus don't advertise utilization timing because complexity keeps you dependent on paid monitoring services. The whole industry benefits from people believing credit improvement is slow, mysterious, requiring patience and perhaps paid assistance. The reality? Credit scoring follows mechanical rules. Those rules are knowable. Once known, they can be optimized. The gap between people who understand the rules and people who don't translates directly into wealth differences over time. Someone maintaining 780 instead of 680 pays dramatically less interest across their lifetime. Lower mortgage rates, lower auto rates, better card terms, reduced insurance. Savings compound over decades. These strategies work because you're operating within the system's actual rules, not the simplified stories told about those rules. You're not cheating, not exploiting glitches, using features that exist by design but aren't publicized by institutions that profit from your ignorance. Patricia's 140-point jump changed her financial trajectory permanently. The $247,000 she'll save will fund her retirement. That knowledge applies to every credit decision for the rest of her life. That same knowledge is now available to you. The loophole isn't hidden because it's illegal or unethical. It's hidden because nobody with a profit motive benefits from you knowing it. Now you know. What you do with that information is up to you. If this hit hard, you're not alone. Comment below. What's your current credit score range? Below 650, 650 to 720, or above 720? I'll reply with your optimal first step. And share this with someone paying 7% on their mortgage when they could be paying 5%. They need to see it. Subscribe. Hit the bell.